Hello and welcome to our latest Insider interview. I'm Kyle Caldwell and today I'm joined by Job Curtis, who is Fund Manager of the City of London Investment Trust. Job, great to see you again.
Very good to see you.
So Job, for several years now, the UK market has been unloved. There's been various headwinds such as Brexit, COVID. We've had a number of different UK Prime Ministers. Now that there's a new government in place and there's potentially going to be some political stability, will this boost sentiment towards the UK stock market?
Yes, I mean, you're absolutely right. The UK stock market's been out of favour, and as a result, we've been seeing a lot of takeovers of UK companies from foreign companies because our shares are undervalued relative, in my view, relative to overseas market. I mean, that's some of the evidence. Yes, I think an element of political stability is helpful. Certainly the new government has set out to be fiscally responsible, which investors will like, and they've also prioritising growth, which should be good for equities, particularly if it embraces the private sector, which they do seem keen to do. So yeah, I think it should be a positive. I mean, the devil's going to be in the detail, really, and it's very early days as we talk today, and what they actually come out with in terms of kind of new laws, etc., will be an important factor. But obviously, it's a big contrast to, say, a country like France, where they've also had elections and the parliament's ended up gridlocked with some quite extreme elements, on either side. So, so I think it is overall, it must be a positive factor for the UK.
And are there any types of companies or particular sectors that stand out for you that may benefit from a Labour government?
Well, Labour have outlined that they want to build more homes, which I certainly think the country is crying out for new houses. There's a generation out there renting who'd like to own, and there's people sort of still living with their parents, etc. So, and one of the ways the Labour are going to do it is obviously reduce planning constraints. Well, that's what they're setting out to do, and they may be better placed to do that than the Conservatives, who kind of had, who perhaps had too many of their own. The people who voted Conservative didn't want the houses built in their backyard, so to speak. So, so if that does happen, it should be quite good for the house builders. And City London, we own Taylor Wimpey and Persimmon, two volume house builders, and I would think they would be well placed to benefit, and to a lesser extent maybe the building materials companies as well, or in a sense, but when we own Ibstock, which is one of the UK's biggest brick makers, and also Marshalls, which makes paving stones, and also roofing products. I mean, the only caveat on that is to the extent that some of the infrastructure projects get stopped, because of the tight finances. I mean, that might be a bit negative for the materials producers. But I think that's certainly one area, if you want to get the economy growing, it is an obvious area, is to boost house building.
Another headwind has been rising levels of interest rates. Now, it looks like the next move from the Bank of England will be a cut rather than further increases. Is that a positive for the UK market, and have you been positioning the portfolio to benefit from lower interest rates? Yes,
I think obviously interest rates had to go up a fair amount because inflation got very high, got up to 11%, and now inflation is back at the Bank of England target of 2%. But having said that, there's still kind of wage increases going through quite substantially above that, and so I think it's tough in the labour market. It's quite tight. I think it's tough for the Bank of England in terms of they've got a decision coming up. So. My view is that we might get. I think the interest rates have peaked, but I'm not on the camp who thinks we're going to get sort of dramatic cuts, and we may get a cut in August. And it's kind of on a knife edge. But I think I'm not somebody who kind of sees interest rates going down to the kind of ultra low levels they were back in the pandemic. So I kind of wouldn't. I haven't built my portfolio's kind of built more on kind of longer term factors rather than as I don't see interest rates changing massively. I haven't kind of built that in, and we're more sort of bottom up looking at the companies and their valuations rather than kind of running it too much on a kind of macro theme. You have exposure to banks, so if they're in the prospect of lower interest rates, I'm assuming that's a position you would in theory keep, due to your view that interest rates, they're not going back to the days of being 25 basis points. Yes, I mean those ultra low interest rates in some respects weren't helpful for the banks because obviously they make a profit margin between the rate at which they pay depositors and the rate at which they charge lenders, and it's much harder when interests are virtually zero to earn that. But they've had a particular advantage in that they have a lot of their kind of funds they hedge out for say 5 years, and so they've got them locked into what the old very low rates, and as those hedges come up, they can re-hedge them at much higher rates as we got currently. So I think and banking is obviously quite complex, as we all know, and it's also very dependent on the state of the economy. So to the extent that kind of obviously interest rate cuts help growth and stop companies going under, that's positive for the banks. So there's a host of factors, but overall, I'm quite positive on the bank sector at the moment. I'm more positive than I have been for over 20 years.
Investment trusts, they have the ability to gear, which is borrowing to invest. Could you talk us through your approach to gearing, and if you became very confident about the prospects for the UK market, would you significantly increase those gearing levels?
Yeah, I mean, we are quite a conservative investor, but as you say, gearing is an advantage investor trusts have got in rising markets. It will help amplify returns. They would do the opposite effect in falling markets. I mean, we were able to take out some very cheap long-term borrowings in the period when interest rates were very low. So we actually borrowed £50 million at 2.94% annual interest rate. That goes out to 2049, and we've also borrowed even cheap at 2.67% going out. This is £30 million going out to 2046, and so those interest rates are locked in, and that was done when the base rate was kind of 0.5 or something, and so we took advantage of that, and so our investors, our shareholders, will benefit from those really low interest rates, and we can reinvest in our portfolio, yielding sort of shares we buy yielding 4.5, and so that we consider as strategic gearing, and we got roughly about 6%. That gives us gearing about 6% based on the strategic gearing. Then we've got also a bank facility, which and that's based off kind of where current interest rates are. So that's a lot more expensive. So we can use that, but we have to be a bit more confident that we're really going to make money on that one. Whilst I think those longer term borrowings, unless the market gets really expensive, which isn't in our view at the moment, they're kind of strategic and kind of they're locked in and will, in my opinion, give our shareholders a decent benefit over the years to come, next quarter of a century.
You have some exposure to overseas listed companies. A company you held for a long time but you no longer hold is Microsoft. Could you explain why you sold it?
Yes, I mean, Microsoft is a great company. I mean, I bought it when it was quite out of favour back in 2011 when people hadn't really heard of the cloud, and people thought Windows was kind of going ex-growth, etc. And when I bought it was on a 3% dividend yield, and it was in various other valuation measures it was really quite good value, and it's done. Shares have done extraordinarily well. They've gone up more than 10 times, and I still think it's a great company. I'm nothing against the company at all, but I just, in terms, I mean, one example of valuation is actually its market capitalization, which is the value of all its shares. Is worth more than the whole of the FTSE 100 index when I've sold the final part of the holding. So all our companies, the FTSE 100, and so I've just I sold it just because of the opportunities available in UK equities, and so I could reinvest in really good quality companies paying dividend yields of 3 to 4%. So it was more of that type of move, and our fund is predominantly in UK shares. We're allowed to go, as you say, 20% overseas listed, but I think Microsoft's kind of more, for people, looking, obviously if you're in a global fund, you're almost bound to be holding it, or a technology type fund. But we certainly were able to improve our dividend paying potential with reinvesting back in some good quality UK shares.
And could you give us a flavour of the international exposure that you do have? Could you name some of the biggest holdings?
Yes. So in the oil sector, we have Total Energies, which, when Shell and BP sadly cut their dividends in 2020, Total didn't. This is a French-based international oil company. And so I switched some of the holding in Shell into Total, which was the right decision because actually it was a low point for oil shares generally. So if I'd kind of just sold Shell, we'd have lost out by that. So we've kept in the sector through Total, so which has delivered for us quite nicely. In pharmaceuticals, AstraZeneca is a great company. It's always been quite a low yielder. It's a top 10 position for us, but we're underrepresented relative to the market average. So we've actually got Merck of the US, which is also a leader in the cancer field, in immunotherapy field, and we've had that for a number of years. We've also got Novartis, which is a Swiss-based pharmaceutical company. So those are kind of a couple of areas where we find the overseas holdings very helpful.
And finally, I've asked you the skin in the game question before, so I'll slightly tweak it this time around to ask, when was the last time you increased your personal holding in City of London? Have you been attempting to try and take advantage of these low valuations for the UK stock market?
Well, so I think, as you probably know, my holding got slightly over 300,000 shares in City. So today's share price is worth almost £1.4 million. But we disclose it once a year in the annual report, which comes out in September, and so we don't really disclose it between annual reports. But all I can say is that every year it's either gone up or stayed the same. It's never gone down. So, and I think you can take it from me that it won't go down while I'm manager of City of London.
It's great to hear. And Job, thank you for your time today.
Pleasure.
So that's it for our latest Insider interview. Hope you've enjoyed it. Please let us know what you think. You can comment, like, and do hit that subscribe button. And hopefully, I'll see you again next time.